Summary on the Little Book of Common Sense, Investing by John Bogle. The Simple Secret to Winning at Investing. A deep dive into John Bogle's common sense approach. Imagine you're at a bustling casino, surrounded by flashing lights, spinning wheels, and eager players betting big. Now picture one quiet corner where a small group sits calmly, collecting steady winnings without chasing the chaos. That's the difference between most investors and those who follow John Bogle's advice in the Little Book of Common Sense Investing. Published in 2007 by the founder of Vanguard and the creator of the first index mutual fund, this book isn't just a guide. It's a revolution wrapped in simplicity. Bogle's message? The best low-cost index funds are your ticket to long-term wealth, and trying to outsmart the market is a loser's game. Let's unpack this gem of wisdom, explore why it works, and see how you can use it to secure your financial future. Who is John Bogle, and why should you care? John Bogle wasn't your typical Wall Street hotshot. Born in 1929, he grew up during the Great Depression, worked his way through Princeton, and in 1974 founded Vanguard, a company built on putting investors first. In 1975, he launched the world's first index mutual fund, a move so radical it was mocked as Bogle's folly. Today, that fund, now the Vanguard 500 Index Fund, manages trillions, and Bogle is hailed as a hero for everyday investors. His book distills 55 years of experience into a clear, compelling case. Long-term stock market investing strategies rooted in simplicity beat the high-stakes gambling of active management every time. Why listen to him? Because Bogle's not selling you a get-rich-quick scheme. He's handing you a roadmap backed by data, endorsed by legends like Warren Buffett, and proven by decades of market history. Whether you're a newbie investor or a seasoned pro, this article will break down his ideas into bite-sized, actionable insights. The Gotroc's Parable, a tale of greed and common sense. Bogle kicks off with a story that's as entertaining as it is enlightening. The Gotroc's family. Picture a wealthy clan who owns every stock in America. They're raking in dividends and earnings growth, living happily as their wealth compounds. But then some smart cousins decide they can do better. They hire helpers, brokers, advisors, managers to trade stocks among themselves, chasing bigger profits. What happens? The family's total wealth grows slower. Why? Because every trade, every fee, every tax nibbles away at their pie. By the end, a wise uncle steps in, fire the helpers, hold the market, and keep 100% of what businesses earn. This parable isn't just a cute story. It's the heart of Bogle's philosophy. The stock market isn't a slot machine. It's a machine that reflects the real profits of real companies. The more you mess with it, the less you keep. How to maximize investment returns with minimal fees. Own the whole market through an index fund and sit tight. It's that simple. Why index funds beat active management. The numbers don't lie. Let's get to the meat of it. Why index funds beat active management isn't a hunch. It's math. Bogle calls it the relentless rules of humble arithmetic. Here's how it works. The market's return. From 1900 to 2005, U.S. stocks returned 9.6% annually, 4.5% from dividends, 5% from earnings growth. Compound that over 106 years, and $1 grows to $15,062. That's the power of businesses doing their thing. Speculation versus reality. Short-term stock prices swing wildly due to emotions. Greed pumps up price to earnings. P/E ratios, fear tanks them. But over decades, these speculative returns cancel out, leaving the investment return, dividends plus earnings, as the driver. Costs kill. Active managers, those hotshot fund pros promising to beat the market, charge fees 1 to 2% annually, trade a lot 100% plus turnover, and trigger taxes. After costs, their net return lags the market by 2 to 3% per year. Index funds? Fees as low as 0.04%, minimal trading, tiny taxes. Bogle's data is eye-opening. From 1928 to 2006, the S&P 500 and total stock market index tracked each other almost perfectly. Meanwhile, the average actively managed mutual fund underperformed by a wide margin. Why? Because all investors, as a group, earn the market's return before costs. After costs, active funds lose ground. It's not that managers are dumb. It's that their expenses make outperformance a statistical impossibility for most. Think of it like a marathon. The market runs at a steady 9.6% pace. Active managers start with weights, fees, trading costs, taxes, slowing them to 7% or less. Indexers? They're unburdened, cruising at 9.5%. Over 30 years, $10,000 at 9.5% grows to $152,000. At 7%, it's just $76,000. That's half the wealth for twice the effort. Best low-cost index funds win by doing less. The emotional trap, why we sabotage ourselves. Here's where it gets juicy and a little embarrassing. Bogle doesn't just blame Wall Street. He points the finger at us, the investors. We're emotional creatures, wired for overconfidence and excitement. We chase hot funds after they've soared. Think tech funds in 1999, then dump them when they crash, 2002. Bogle cites studies showing fund investors lag their funds' reported returns by 3% annually due to this timing madness. Add that to the 2% cost gap, and we're capturing less than half the market's return. Take my friend Mike. In 2020, he jumped into a hyped-up tech fund after it gained 50% the prior year. By 2022, it was down 40%, and he sold in a panic. Meanwhile, his boring S&P 500 index fund chugged along, up 10% over the same period. Mike's story isn't unique, it's the norm. Bogle's fix? Long-term stock market investing strategies that ignore the noise. Buy an index fund, hold it forever, and let compounding work its magic. The magic of compounding. Time is your superpower. Bogle's a big fan of miracles, not the religious kind, but the financial kind. He calls compounding little short of a miracle. Here's why. That 9.5% annual return doesn't just add up, it multiplies. Invest $1 at 9.5% for 10 years, and you've got $2.48. Stretch it to 50 years, and it's $93.48. Inflation knocks that down. 6.5% real return gets you $23.31, but it's still a fortune from a single buck. The catch? You need time and patience. Start at 25 with $5,000 in a best low-cost index fund, like Vanguard's Total Stock Market VTI, at $5,000 yearly at 9.5%, and by 65, you're sitting on $1.2 million. Start at 45, and it's just $330,000. Time turns small bets into big wins. Active traders flipping stocks or funds miss this. They're too busy paying the helpers. Diversification. Don't put all your eggs in one basket. Ever hear the phrase, don't bet on one horse? Bogle takes it further. Don't bet on one stock, sector, or manager. Companies fail. Think Enron or Kodak. Sectors tank. Tech in 2000, real estate in 2008. Managers flop. Only 1 in 5 beats the market over a decade, and good luck picking the winner. An index fund like the S&P 500 or total stock market owns everything. Thousands of stocks across all industries. If one flops, others pick up the slack. Bogle leans on Occam's razor. When there's multiple solutions, pick the simplest. The best low-cost index funds diversify effortlessly.